Okay. Good afternoon, everyone. If all the panelists could please turn on their cameras, also Charles-Antoine, please. Okay, perfect, thanks. So good afternoon and welcome to you all, both the panelists and the attendees, on today's debate on the topic non-performing loans, a critical stock take, organized by the Florence School of Banking and Finance. My name is Elena Carletti. I'm a professor of finance at Bocconi University, and I'm very happy to moderate today this very timely debate. So let me welcome the speaker in order also of their appearance in terms of speaking. So we have Nicoletta Mascher, who is the head of division within the chief economist department at the European Stability Mechanism. So she is the person dealing with banks, basically within the ESM. Then we have Charles-Antoine Dozin, who is an executive director in capital markets and the bank solutions at Morgan Stanley. And then we have Nicolas Véron, who is a friend of the Florence School, if I may say so, and he is a senior fellow at the Peterson Institute for International Economics and also the Bruegel in Brussels. So thank you for all the three for joining us today. So the debate is clearly very important, and I want to leave as much as time for our debate, so I won't steal any minutes. Let me just say that we start with the Nicoletta, who will give us a presentation on basically what we learned from the past, what is the stock taking, and what we can somehow learn also for the current situation and the future. She will speak for about 15 minutes, and I kindly please ask her not to go beyond that time. And then we will have the two commentators, first Charles-Antoine and then Nicolas, and for you, as you know, the time is 6 minutes. We have an hour, we have a lot of questions already coming in, we have a lot of very informed attendees, so please try to keep at least half an hour for the debate. For the audience, you know that you are always welcome to write your questions in the Q&A chat box, not please in the chat box, but use the Q&A so that we can collect them all together. Try to ask brief questions, and if you can, with the name of the person you would like to address the question to, if you have a question, I mean, if the question is addressed to a particular speaker. And please try to be brief. So without further ado, let me give the floor to Nicoletta. Thanks again for suggesting actually that we organize this panel, and to the ESM for preparing the material. So the floor is yours.
Thanks a lot, Elena. I'm going to share my presentation. I hope you can all see it now.
We can see and hear you very well, so please go ahead. Thanks.
Very good. So thanks a lot for your introduction, Elena, and thanks for having me here today. I'm very pleased to participate in this, as you said, very timely discussion about non-performing loans in the euro area. And as you said, I will focus my contribution on the experience in those countries that received financial assistance during the last euro area crisis. We hope that this experience can still be useful to prepare for the next surge of NPLs, which is unfortunately expected given the current circumstances. I will draw on two exercises of independent evaluation together with our experience on the ground. The information and data I used is in the public domain. The opinions I may express here are mine, of course. So let's take a look at the list of contents. So I will focus first on some comparisons between the current situation and the past situation. Then we will analyze the macroeconomic conditions at the time of the euro area crisis for our beneficiary member states. And then we will try to take some lessons from this experience, and we conclude with some factors to watch. So a large fraction of the financial support provided to countries in the last crisis went to resolve or recapitalize banks that were saddled with non-performing loans. So we know that the current crisis is different, and even more importantly, the institutional environment is much more mature. But still, we want to make sure that the NPLs do not morph again into a financial stability issue. So let's take a glance at what happened in our beneficiary member states. High non-performing loans were a common feature in these countries, but success was mixed and some legacies still remain. Here you can see the NPL ratio cumulative change before the program request and thereafter in each country, up to the peak of the NPLs cycle. And as you can see clearly, in some countries, the solution was quicker and less painful, like in Ireland and Spain. In others, NPL continued to grow over the program period and after that for some time. As said, the current environment looks differently, and we can take a look at the euro area situation now. Here you can see that NPLs have almost come back to pre-crisis level in most of the countries. The situation has broadly normalized with a much more narrow dispersion across countries. And this is still the case in Q2 2020, although we have seen impairment charges growing and banks have begun to recognize new NPLs. But if we look at this evolution under the microscope and we group banks and countries per NPL quartiles, we see that the trend is still on a downward trajectory for all groups, but levels are still very high in the riskiest part of the distribution, as you can see from the blue line on the left. Moreover, on the right, we can see the share of performing loans under moratoria for a selected group of countries. The selection has only to do with availability of data, but this allows us to see that if we assume that this portion of the portfolio is the part most at risk, we see a high level of risk in some of the countries that already have a relatively high percentage of non-performing loans. On top, if we look at some profitability indicators, return on equity and cost to total assets, we see that always looking at the blue line, banks settled with non-performing loans were not able to return to profitability for some years and only approach higher levels in the last 2 years, just before the pandemic kicked in and reverted the trend. Even more interesting, we found a distinctive pattern in the weight of operational expenses in the riskiest banks with little or no sign of improvement, as you can see here on the right. We know that there is also a bright side of this story. Progress achieved in building up capital buffers has been impressive. If you compare the capital ratio at the beginning of the last crisis and the current level. And if we consider all voluntary buffers and the newly released buffers thanks to the support measure in place, banks are in a position on aggregate and based on ballpark estimates to absorb NPL provisions for NPL levels that are close to the peak of the past crisis. But as we have seen for NPL levels, looking only at averages in the population of banks is misleading. So there is undoubtedly a weak tail of banks. And these numbers are useful to frame the discussion, but we need to look deeper into the drivers of NPLs evolution. So in this table, we have considered the 5 beneficiary member states, and we have identified 3 main sources of vulnerabilities among the macroeconomic factors that are common to all these countries. Slowing GDP growth before the crisis, fast loan growth, and real estate bubbles, over-indebtedness of the private sector. So these were common features, but combined with different structural features resulted in different outcomes. And in particular, the shortcomings in the institutional and legal setup were a strong hindrance to promoting swift solution. Let me just say a few words on the specific cases. If we take, for instance, Ireland and Spain, the crisis was clearly aggravated by the real estate asset bubble, but the underlying economic conditions were fundamentally sound The crisis was preceded by a period of strong growth, and non-performing loans decreased relatively quickly, also thanks to the disposal of assets to an MNC. But more importantly, structural reforms were implemented during and after the programs, and the strong institutional framework helped to solve the NPL. If we consider Cyprus is a bit a particular case, but all in all, in all these three countries, programs perform relatively well in terms of speed of adjustment, given the initial assumptions. While if we look at Portugal and Greece, banks were impacted first by the sovereign debt crisis and the longer period of recession. NPLs spread across all loan segments and continue to grow during and after the program. In those countries, banks actually were not at the origin of the crisis, but the institutional weaknesses made the solution quite hard to achieve. So if we now look at the current situation in the euro area, and here we plotted GDP growth and credit growth. But we can see that most of the imbalances that we observed in the past, especially excessive credit supply and real estate overvaluation, seem to have disappeared. But the impact of the pandemic, as we have seen, is unprecedented in magnitude. And the combined supply and demand shock has led to a sharp contraction in economic activity, despite the forceful policy reaction. At the same time, lending has been picking up, although in the last quarter we have seen has come to a halt. And the increase in lending was driven by acute corporate liquidity needs for inventories and working capital, but in some cases also for restructuring and debt refinancing. Last point on the macroeconomic condition. Corporate sector debt has remained very high since the last crisis and further increased in some countries. And we have seen how nervously markets can react. At the height of this crisis in April, we have seen corporate credit spreads widening to historic highs. So against this backdrop, we see the risk that this second wave of infection may actually create again a double dip recession, jump in unemployment and corporate downgrades, and therefore a sharp rise in payment delinquencies and non-performing loans. So let us move to the outcomes we have seen and lesson learned. So in general, we have seen that the wait and see strategy does not pay off. This is nothing new, but here what we want to say is that there is a clear rationale behind this bank's behavior, and this rationale may become even more acute in this crisis. Banks will strive to preserve their relationship with customer, and in a way, this is actually what they should do, as long as customers are viable or only facing temporary difficulties. And we need to recall that banks have been called upon to support the public policy response and ensure continued lending to the economy. And moreover, expected recovery rates for, let's say, organic solutions will be even higher in an ultra-low interest rate environment. So it is not easy to walk this fine line between risk on the one side and support to recovery on the other side. One more important point here to make maybe is the issue about the bid-ask spreads in NPL portfolio transaction, which is still wide, both in outright transaction and securitization. We know that the NPL market is what we describe in literature as a market for lemons due to all types of market failures. So you can find information asymmetries, high sunk cost for due diligence. And even in the current environment where markets compared to the past crises are much more mature, this remains a major issue. And price discovery will be costly to the heightened uncertainty, and this will make the solution harder. In these slides, I just want to summarize the very general lesson learned, and in the next one, some more specific points to take. The main lesson, maybe, and the most obvious, is that the success in resolving non-performing loans depended on the quality of the program. So its relevance to identify gaps and the source of the problem. And this was essential also to get ownership from governments and national authorities. But it's also important that the NPL strategy is comprehensive enough, and it includes not only financial sectors intervention, but also structural reforms. What we can say is that probably now we have some time to prepare, because thanks to the measures in place, NPLs are still dormant in a way, but they will surface soon once these measures expire. And this time can be used to accelerate projects also at banking union level, including the banking union project. Another point I want to make is that it is crucial to integrate in this strategy different tools. We don't think there is a single way to clean balance sheet. There is no silver bullet to impede a new build-up of NPLs. The deployment of different tools is to be bespoke to the specific needs of a country, of a bank. And given the systemic scope of this crisis, there is a need for strong coordination across countries, banks, and authorities, and more transparency. About the speed of action, a lot has been said. I think it's definitely important to be quick, but also the intensity is to be cautiously pondered to contain the social loss and to avoid the risk of jeopardizing viable firms. Some banks will emerge more vulnerable than others, and this can be an opportunity to revamp the banking industry and foster more consolidation, reducing overcapacity. About the macroeconomic measures, monetary and prudential policies, these are all there to help, and the phasing out should be calibrated to avoid the procyclicality and cliff edge effect. And in that, probably also macroprudential measure can help in the transition. My second to last slide, and the most important one, is about some critical objectives that we have identified for effective NPL resolution. We have grouped measures under 4 main strategic goals. There may be others. Valuation, transparency, and market functioning, effectiveness and efficiency, but also ownership, fairness, and social impact. I could go through all the identified gaps, but given the time constraint, I'm going to mention just a couple of areas where more effort is still needed. And in particular, looking at one of these goals, market efficiency, I want to stress the importance of the information availability, standardization, and disclosures. Also in countries with advanced system and infrastructure, the industrialized large-scale disposal of assets may be hampered by the lack of reliable, complete, and comparable data. All the ongoing initiatives are essential to deepen the market for non-performing loans and foster the creation of transaction platforms. We also welcome all the initiatives related to the standardized loan level data and unified databases. These are all essential steps also to allow the creation of a European AMC and to make the NPL transaction platforms really work well. On top, with more standardized data, it would be easier to exchange information among banks, and in this way facilitate also organic solution, especially when borrowers have exposure towards several banks. Let me just make one final point about my green slice of the pie that is there to draw your attention, because I think there is a point to make about the perceived or real fairness of the interventions and reforms, especially in this crisis. There are still a lot of gaps to bridge in the judicial system, personal insolvency frameworks, also in the tax rules, where in some countries, for instance, that haircuts are considered income for debtor, but also non-NPL related structural reforms, which will be crucial to ensure a strong social safety net and more integration. Let me just recap what we have discussed so far, and then we'll be happy to take your questions. So we have compared the different crises, but we have seen also that there are striking parallels to make. We can benefit from a stronger institutional environment, and we have some time to prepare to complete several important reforms. We think that it's important to develop well-rounded and multi-pronged strategy. Although industrialized solutions can help, these are part of the solutions. At this juncture, sustainable and inclusive growth probably should be the overarching priority in all policy actions, including in this field. So there is definitely an important social dimension to this problem, and it's important to look at the NPL issues also from this angle. Thanks a lot for your attention, and I hope I didn't exceed my time limit for
just a little bit. Just a little bit, no worries, perfect. So thank you very much for this very exhaustive presentation. I see that there are already some questions, and I have also many. But before we go to the debate, now Charles-Antoine, please, if you can have your comments first.
Absolutely. Thanks, Elena. I'll try and keep it to the 5-6 minutes. I want to take the time allotted to talk about three things, or re-emphasize 3 points. Some of them were already made by Nicoletta. But first, it's important to remind ourselves that banks are well positioned to face the challenge that we have ahead of us. And I'll say give you a few examples as to why we think that is the case. Second, we do have to recognize, of course, that there is a wave of NPL that is coming, and we need to prepare. And I'll give you a sense of what we hear from conversations at our level with banks across Europe. And third, I think I want to spend a little bit of time going through what I would describe as the toolbox for addressing effectively this NPL problem that we know is around the corner. So look, on capital positions, it is clear that thanks to obviously the good work that was done over the last so many years since the introduction of Basel III, when you look at the European landscape, financial institutions these days, not only obviously have we increased the quality of capital, but certainly the quantity of capital. So going into the COVID crisis, we effectively had capital ratios that were pretty strong by historical standards. That's point number one. Point number two, obviously the regulatory measures, flexibility that was introduced by the SSM and other national regulators in the early days of COVID have created on a technical basis quite a lot of capital on top of what we already had. We've removed the P2Gs, we've lowered the countercyclical buffers, we made the CCBs usable in theory, although in practice it's less the case. All of that has created in theory up to 650 billion of capital that banks could put to use in the form of meeting losses if they arise from NPLs, or potentially obviously RWA inflation stemming from ratings migration, which is sort of the same thing. So those 650 billion are quote unquote, I think largely in line with the losses that were experienced during the great financial crisis. So it gives you a sense of how effectively prepared we think we are. Last but not least, obviously there's been a lot of provisioning, and I'll come back to you in a second, in Q1 and Q2, a little bit less these days in the earnings seasons that we're going through at the moment. But banks are effectively returning to profitability. And that's key and critical, right? Because that first line of defense to be able to take those provisions and face those losses is to be profitable. Obviously, we know it's a chronic issue for the system. So when I say profitable, let's bear in mind that we're looking at a sector that's been structurally challenged for many years. But we have to recognize that we're still making profits, which is obviously in the grand scheme of things positive. Couple words on provisioning. Provisioning is an art much more than a science, as I think everyone will know. It's pretty technical. It's very much driven by assumptions and obviously management judgments and overlays. The narrative that's coming out of the sector, especially now that we're reaching Q3 is that we have done effectively based on the macro projections that we had earlier in the year, and I'll come back to it in a second because that's a key question mark. We are effectively where we need to be in terms of provisioning, and you actually see in Q3 results these days bank making no more provision. Actually, we see a few write-backs and a few unwinds of provisionings that were taken before. The big question is, what do we have around the corner, right? Because we know that the sanitary situation, the health situation is deteriorating. We're going into regional and national lockdowns. So where we thought we'd be a few weeks ago is clearly not, no longer, at least in the same way, on the table. So provisioning good for now based on cost of risk expectations, guidance and outlook, but we may have to revise those guidance, and we don't really know what 2021 holds for us, at least for the time being. Last point there, anecdotal evidence that we see coming out of Q3 results based on moratoria, payment holidays coming to maturity is that clients and borrowers and sort of borrowers seem to be effectively resuming payments in the vast majority of cases. There's been effectively very little to no NPL creation at this stage. And I think for the time being, the evidence seems to be showing that the materialization of risk is not too different from what we would have expected before the crisis. And I'll say a few words about that later. So that's where we are in terms of the banking system. As I said, second point, the wave is coming, right? There's no doubt about it. There's been provisioning being done to stage 1 to stage 2 migration, very little stage 3 NPL crystallization so far, but we know it's the next step. We are in this bit of fluid limbo situations where we are by definition protected by all the government measures, official measures that were put into place, the moratoria, the payment holidays. We're lending obviously with the guarantee of governments. So we are effectively in a bit of a superficial world, and it's very hard to tell the actual state of balance sheets based on the numbers. The big reveal, as I call it, will come probably in the first part of next year, once we see the expiration of all those government measures. Until then, it's difficult to put real numbers on the impact that the crisis will have, even if, again, we think that we are well prepared both with provisioning and capital basis. Just to cite one number, based on the SSM literature, that we could go in a worst case scenario of a protracted recession up to 1.4 trillion of NPLs, which is by definition a very big number. But that is, let's bear it in mind, it's a very sort of worst case scenario estimate. And just to say a few words about the usual suspects in terms of risks and exposures, it's CRE loans, it's consumer lending, it's SMEs, and obviously corporate lending in those industries and sectors that were primarily affected by the crisis. I'll finish up in a couple of minutes I have left by saying a couple of thoughts and views on what I call the toolbox. Obviously, first and foremost, we're talking about operational resolution of those default and those bad loans, those distressed situations. We are seeing banks adding headcount to their teams to be able to process from an operational perspective the wave that we know is coming. That is, I think, important. I must say, by the way, that the call from the authorities, the SSM in particular, for banks to be prepared operationally in our discussions has very much been understood, and that call is heeded, and we can see it in the numbers in terms of banks strategically are doing to prepare to pave the way for what we have ahead of us. I must say our discussions, and this next point, on what can be done with NPLs in terms of sell downs, in terms of liquidation, in terms of taking them off balance sheet, have clearly picked up. And I think people are keen to understand what are the options, what's the market, and what do the solutions look like. So that is this clearly obviously a very high level of attention and time being spent on those questions. Couple of words on the NPL market, what I call the NPL market, which is institutional investors, sort of pension funds, private equity players, and specialists like debt collectors. It's a market that I would describe and characterize as in transition, of course, because there's a lot more uncertainty than before the crisis. But it is a market that is functioning. We've seen transactions being closed in Cyprus, in Greece, in Ireland. So we can find ways to bridge the valuation gap, the bid ask that Nicoletta was talking about before. it takes innovation and creativity. We use tools and contractual features such as deferred payment clauses or earn-out clauses. But long story short, there are possibilities to make things work and crystallize that appetite and find solutions in specific situations. There are obviously practical still impediments and obstacles in terms of financing, in terms of the practicalities of due diligence. It's difficult to do a due diligence by Zoom these days. That is something that those are things that will get resolved. But the point I'm trying to make is that it's a market that's been functioning historically and is still functioning as far as we are concerned. That being said, let's be honest, when we look at the volumes, 200 billion in 2018, 80 billion in 2019, and 40 billion year to date. We think we're going to probably get to 80 billion this year. When we compare that with the 1.4 trillion that I was mentioning before, there's clearly a need for a bigger bazooka for something else. Then let's discuss what that something else is. And obviously it brings me naturally to the next point, which is this concept or notion of pan-European bad bank, which, just to give you a couple of thoughts from my end, the additional firepower can only be helpful, right? I mean, we need all the help we can get. There's a lot of questions around implementation, around level playing field, around valuation, around potentially not crowding out the private appetite for NPLs, because at the end of the day, we also want to have exit options for those government-sponsored solutions. So the devil is in the details, but the idea in itself, I think, merits support and attention. I'll stop here and pass it on to Nicolas.
Nicolas, please. Given that we are running slightly later, so please stick to 5 minutes.
Yeah, I have much less to say.
I doubt it, but go.
I've looked at some of the questions, and there's a question which I think is very good, which why worry about NPLs? What's the challenge here? And I think the challenge is bank soundness. The challenge is not individual assets, it's the viability and soundness of individual banks as a whole, with their entire balance sheet. And of course, there are operational concerns as well, but most banks in the Eurozone have, skills in their team. So the real challenge is not operational, it's financial, and it's about bank soundness. I think that's very important to keep in mind, because there is a little bit of NPL fetishism in the discussion, as if there are some bad assets out there that need to be dealt with, and the rest of the banks are completely fine. And I think that can be very misleading, and actually that's a lesson of the previous crisis. One thing that Charles-Antoine said, which I think is very important, is at this point, we don't observe a market failure. Market for NPLs has gotten increasingly structured in the last few years. It was plausible to say there's a market failure 5 years ago. I think the last 3 years, it hasn't been plausible. And COVID, fortunately, has not changed that. We see a number of transactions. There is a price formation mechanism. We could wish the market to be more liquid, but by nature, it's not a very liquid market. And I think that any sort of public intervention has to take into account the fact that the market is not perfect, but it's not failing. So I would emphasize one thing that Nicoletta has said, NPLs need to be recognized early. That's always the case, but of course we're in a situation of uncertainty. So as long as the uncertainty is there, and Charles-Antoine has also mentioned it, that has to be taken into account. And I have sympathy with the stance that has been the ECB's, particularly for Q1 numbers, when there was this debate about IFRS 9 and the like, that recognition should not be based on the most pessimistic of assumptions. There should be realism, but not excessive pessimism that would exacerbate the cycle in the context of uncertainty. That's a very difficult balance to keep, but I think that's still how it has to be thought of. Similarly, and even so it's not really our issue, but I've seen questions, there shouldn't be any reversal of the measures to recognize NPLs rigorously. And I should ask, there should be no reversal of the measures taken to conserve capital, such as the suspension of dividend payments. At this point, given the high uncertainty and the downside risks, some of which are materializing as we speak on the health front, letting banks pay dividends makes absolutely no sense. A couple of words to conclude on the bad bank, because I see many questions about this. So first of all, this is not about state aid. The temporary framework for state aid that was published in early April doesn't basically lifts all the constraints on state aid with both recapitalization schemes, precautionary recapitalizations under BRD, and asset relief programs. So at this point, state aid is not an issue. But it's not clear that the extent to which bad banks are helpful. And here I would nuance what Charles-Antoine said, because he said it's a measure to be supported. I'm not sure. It depends. The track record of asset relief program, and I use the term asset relief program because I think bad banks is an ambiguous expression because it's often used in resolution. So a bad bank in resolution, asset separation, you have a good bank, a bad bank, that's perfectly good practice. It's the right thing to do. But that's when a bank has been already judged to be failing. And it's a completely different proposition from an asset relief program where the public sector buys assets from going concern banks, where you have a big problem with setting the price for the transaction. So I won't, from now on, I won't use the word bad bank, which is too ambiguous. I will refer to asset relief programs. Asset relief programs have a very unpromising track record. There have been a number of such programs. They have never been able on their own to address a situation of systemic fragility. And I think Andrea Enria has mentioned two precedents, the Swedish crisis of the early 90s and Japan in the 90s. In the Swedish case, there was no asset relief program. There were resolution bad banks and operational bad bank so asset separation within going concern banks, but with no transaction with the public sector. And in Japan, it's generally recognized that bad banks were too little too late, asset management companies, sorry, and that what resolved the Japanese crisis was a public recapitalization program and triage of the banks, not the AMCs per se. There are very conclusive papers, I think, from Hoshi and Kashyap in particular on this. So I think the ECB at this point is sending an ambiguous message, ambiguous on whether the sector is fragile or not. We've heard a lot about, banks are not a problem, they are sufficiently capitalized. Then the question is, why worry? Ambiguous on whether the solution has to be European or national. Mr. Enria's op-ed seems to indicate that the ultimate risk-taking should be national and that if there are losses, it should go to national budgets. That creates risk for the integrity of the Eurozone. And ambiguous on whether that should involve the subsidy or not to the banks, which of course raises major questions of public acceptability. I'll stop there ahead of my 6-minute limit.
Thank you, Nicolas, very good. So let me just open the debate now, and we have really lots of topics to discuss about from all the three of you, but let me somehow a little bit organize. On this ambiguity that Nicolas was referring to, relating this ambiguity to what both Charles-Antoine and Nicoletta has said about the fact that in aggregate, the banking sector has enough capital. So if in aggregate, the banking sector has enough capital, Nicolas says, why should we worry? But we know variance is different from mean, as Nicoletta also said. So how are we worried about the variance? And if we are worried about, if the main issue is not the mean, but the variance, should we try and start thinking about different solutions for, let me call them stronger banks and weaker banks? Because the problem I'm seeing is that, as Nicolas a little bit was saying, on the one hand, we say everything is fine, they have a lot of capital, and we put all banks in a mean. But on the other hand, the regulators are worried. And I also see that the stronger banks want to differentiate themselves from the weaker banks. So that would be the occasion to really revamp the banking industry, as Nicoletta put it before. Don't we have to go for a distinction in terms of addressing these two categories of bank? And within this, there is also the dividend story. The Nicolas says banks should not pay dividends, but the stronger banks, why should they not pay dividends at the end of the day if they can afford to do everything, if they are really so strong? And this goes also to one of the questions in the chat box. Investors need to be attracted to this sector bank, not because we want to make private banks, bankers rich, but because we need the banks solid enough to support the economy. And the only way is to maintain capital within the industry. So a long story for a short answer from Nicoletta first, and then maybe we go in order and we move to other tools. But I think it is mean versus variance, and whether that is a valid point also in terms of how we deal with this situation is maybe worth discussing. Nicoletta.
Thank you, Elena, for this question. Very difficult one. Also, thinking about my past experience as supervisor. So I would concur with most of the statements made both by Nicolas and Charles-Antoine about, and also looking at my presentation, that the current situation is not worrisome. So banks have plenty of space to absorb potential losses. And the situation seems comfortable up to the level of the NPLs that we observed during the last financial crisis. So this would mean doubling the size of the current NPLs portfolio. But under adverse scenarios, we have seen that according to all authorities, EBA, ECB, and recently also the IMF, there is a weak tail of banks and capital shortfalls could be material. With this backdrop and considering the level of uncertainty of the current situations, differentiating the supervisory approach between stronger and weaker banks probably would give would be the wrong signal to market participants. And also looking at the market capitalizations, it doesn't seem to me that market participants are differentiating their judgment based on the fundamentals of banks, but more based on the current general macroeconomic conditions. So I would find it premature now to go for this differentiation in the approach. But I do see in general the opportunity to develop bespoke solutions also in the supervisory approach. And I think that supervision at European level has gained a lot of experience in this now 6 years since the inception of the SSM supervision. They have a very good knowledge about the single institutions. They have harmonized the rules and practices. So they are best placed to define a solution, define a supervisory strategy that is adequate for the different needs of the different institutions.
I'll say a few words. I think you nailed it, Elena. I think that you talked about, and that is one of the points that we spend quite a lot of time on, making the sector investable again. I think to me this is one of the core issues. We need a market backstop in case there's going to be a need for recapitalization. We also need that, by the way, for consolidation, right? I mean, the consolidation activity that we've seen so far has been domestic, and that hasn't necessitated per se capital injections. But if you want to think about things on a bigger scale, potentially cross-border, there's going to be a need for private capital to also participate in sort of the cleanup and the fixing of the pan-European industry. So working on investability is paramount. I think it should be the alpha and the omega of all the decisions we make. I'll just say 2 words on the dividend ban, because I obviously respectfully disagree with Nicolas here. I think a blanket dividend ban is a blunt tool, and I think the SSM recognized the impact that it has on valuation. And I think if you think about investability of the sector, you need visibility on potential distributions to be able to go to valuation levels that are higher than what we see today, and that all goes effectively to the effect of creating that private bid or that private capacity for potential recapitalizations, as well as a set of consolidation. That is my personal view.
Let me go to Nicolas, and I didn't want to transform this into a dividend story discussion. Let me go to Nicolas instead. So we heard from Nicoletta a lot of tools that have been used in the past. Some of the audience attendees say, but this crisis is very different because maybe NPL before were more coming in sectors that, for example, were related to asset price, to housing bubbles, whereas this time, NPLs are likely to arise in specific sectors that maybe before were very much performing, for example, tourism. So does this call for different tools relative to before?
Let me say a word about the differentiation things. It's perfectly natural that in a situation like the current one, big banks would plead for differentiation. They would plead for sending market signals through dividends. They would say, we're the stronger ones. And you know that, right? Because Charles-Antoine, you work in a big bank, you work with big bank clients. Elena, you're an independent director in a big bank. So big banks want that. They want to be able to say, as Deutsche Bank said during many years, we're strong enough, we don't need public support. We can give big dividends to our shareholders, and that's how the market works. And this is fine in normal times, because that's the market differentiation mechanism. But it's not fine in crisis times. And here I will go with Nicoletta. When there is a general situation of uncertainty and a general situation of doubt, there can be very detrimental consequences to letting the banks themselves try to organize a beauty context, because the incentives are not aligned with the public interest. And what we know from the experience of past crises, I'm not presenting a theoretical model here, this is based on observation. What we know is that when there is a general perception of fragility, every idiosyncratic case becomes systemic. And frankly, the private sector is not going to provide a backstop. If the banking system needs recapitalization, as long as the uncertainty continues, the recapitalization will come from the public sector. That's a fact. And saying the contrary is really going in the direction opposite to observation. Neil Kashkari, the president of one of the regional feds in the US in March or April, said, the big US banks should raise $200 billion from the markets, and that had absolutely no effect, because this is not realistic in the current circumstances in the US, and even so, less so, of course, in the Eurozone. So this is not normal times. We have uncertainty. We have the potential for fragility, and there is a different playbook. And actually, you, Elena, have contributed a lot to this literature. When we're in a situation of systemic fragility, the playbook for public intervention is different. And it has to be system-wide. It has to look at all the banks as one set of challenges. If there is recapitalization, the lesson from TARP and many other examples of crisis is that initially the recapitalization has to be across the board, precisely to reassure the public that it's not going to be a situation of contagion where one bank after the other is seen to be problematic, as we saw in September and October 2008 in the US. And indeed, TARP was about forcing recapitalization on banks, not just banning them from paying dividends, but forcing recapitalization on them, even those who pretended they were strongest, and probably were. Because that was the only way to reestablish confidence. I'm sorry to spend a few minutes on this, but this is so important that I think it has to be said. Similarly, there has to be transparency. And for example, moratoriums are problematic. Extension of moratoriums are problematic in the current circumstances, because that blunts market signals about who can repay and who not. So these are very difficult trade-offs. But the transparency doesn't come through equity prices at this point, particularly not in the Eurozone, where about half of the banks that people worry about, the significant institutions, are unlisted, and the proportion is even larger among smaller banks. So back to your question about securitization and not securitization, but NPL categories. One thing I will say very briefly, because I've extinguished my speaking time here, is that SME NPLs are more difficult to deal with than real estate NPLs. And the reason is well known. It's much more heterogeneous. The collateralization doesn't work the same way. So an SME NPL situation is really, really difficult to address. And that's different from what we had, for example, in Spain or Ireland. Thank you.
So, on this, Nicoletta, can you elaborate a little bit more whether this calls for different tools? And maybe we shouldn't sell them, but we should rather try to restructure them. And also this goes to Charles-Antoine before, that was saying that indeed the banks are enlarging the number of people that within the banks try to restructure the NPLs. Can you maybe say something? Would this call for a different somehow tool, please?
Yeah, this is actually one of the points I wanted to make before when I spoke about bespoke solutions, no? And the fact that this crisis is fundamentally different from the previous one, and the NPL portfolios are different. So we will be facing, likelihood a very granular portfolio of NPLs towards the most exposed sectors that are mainly populated by small and micro enterprises. And this is why we should look at a different solution, because probably the large scale industrialized sale of NPL portfolios is not a feasible solution in most of these cases. So, and here there are two possible alternatives. The most important one, in my view, is the first line of defense. So the NPL restructuring and workout by the internal workout units. And here I'm actually pleased to learn that banks are investing in this activity. And given this crisis is key to move from a form of short-term forbearance to long-term restructuring to actually help these corporates and small enterprises to bridge the transition and possibly regain ordinary business conditions. And if this is not possible, and these, let's say, light NPLs morph into that needs to be collected, then probably we also need to look at other forms of NPL management vehicles, not necessarily asset management companies, like, for instance, the vehicles for securitization transactions that may better cater for very diversified portfolios and also help to differentiate the prices according to a more varied population of investors. And in these, we have good examples with the GACS and more recently with Hercules in Greece that seems to work quite well. Of course, these are complicated structures. They need to be designed in a proper way, but I would put this effort within this general concept of NPL management vehicles, because depending on the portfolios, the size, the type of counterparties, you may need the different schemes.
Thank you. Several people are asking, Nicoletta, still to you, what you think about this AMC proposal of the SSM. I think you cannot escape answering this question, if I may say.
No, well, first, let me say that we fully agree in general on the need for resolute action to expand the tool for more effective NPL resolution strategies at EU level. So this is out of the questions. We have shared the experience we had in the past in these countries also because we saw similarities in terms of potential types of portfolio that we saw in some of these countries. Having said that, I do see some challenges in building up a pan-European bad bank, even beyond the argument of the type of portfolio. And the most important one in my view is the heterogeneity of the insolvency regimes and corporate laws across Euro area member states. This to me seems quite an important hurdle to come up with a real pan-European solution. There is a need for a specific expertise on corporate laws and on domestic regulation. And for that, the proximity could be necessary to concretely execute the transactions. So then you may argue, okay, we can move from a pan-European solution to a network of an AMC. And this, I think, is the solution towards which also the other institutions are moving. And this actually, to me, seems a more viable proposal that could somehow balance the advantages and disadvantages of a fully domestic solution and a total European solution. The idea of having a central hub actually could help to pooling resources and expertise and improving the overall efficiency of this mechanism. The real challenges, however, remain in the pricing mechanism and the funding system. I think these are also the two elements that were highlighted in the article that we read in the Financial Times, and I think that everyone is aware of the need to find a mechanism to distribute the bid-ask spread between the buyer and the seller. And here again, I have learned from Charles-Antoine that there are very good systems in place, and I would be happy to learn more about that. Once this mechanism is in place, we also need to deal with the time of the recognition of the NPLs out of the bank's balance sheet, and what this implies in terms also of accounting rules on the IFRS 9. And if we on top envisage a guarantee mechanism, this of course will need to comply with the state aid rules. Again, here we have seen in the past that there is some room of maneuver in the state aid rule regulation, and I think that this could be an hurdle that can be overcome. And of course, we need to design the funding system of these AMC, which may involve a central body or a pool of different central body, because it will be essential for these large AMC to have a very high credit rating to mobilize funding in the market and set up this framework.
Thank you, Nicoletta. We still have a few minutes, so let me raise another issue, and I'm sure that Nicolas and Charles-Antoine will have a different views on that. Let me start with Charles-Antoine first. Nicolas stresses the dividend story, and we don't want to go back to this. But he stresses also transparency, and he stresses the need somehow to recognize NPL soon, or remain, if you want more generally, strict on supervision and the regulation. On the other hand, we are not distributing dividend. I mean, banks cannot be distributing dividends. So given this tension, some people are asking, don't you think we should maybe postpone a little bit some of the regulatory headwinds? For example, the new definition of default or the calendar provisioning that we know are procyclical, that will require banks more resources, and therefore will again make banks in a weaker position to then maybe go back to a distribution or even to capital level. So is this the right time, given the overarching situation? Clearly, these measures were thought very well before this situation.
Absolutely, thank you. And apologies, I'm gonna have to drop on the hour, but so I'll keep it short. I'm not sure that this is the time to look at more technical tweaks in the rules. I think the most helpful feature was the introduction, or actually the beefing up of the IFRS 9 transitioning arrangements, and the fact that we can protect regulatory capital for maybe 2 years down the line from the moment we make the provisions. I think this is important because it creates a disconnect between effectively the accounting picture versus the regulatory capital picture. So it helps effectively banks maintain their buffers, continue lending to the real economy and not having to raise capital per se, while still sort of taking the provisions that they need to take. And obviously 2 years down the road, that disconnect gets resolved mechanically. So that is very important. I think it should in theory be sufficient to help them navigate effectively this dichotomy of taking the right provisions at the right time, recognizing the NPLs when they crystallize, but not having necessarily to worry immediately about the capital implications.
Okay, thank you. Nicolas, your view on this? Although I'm pretty sure that we know your view on this, and we have 1 minute and then we need to...
Yeah, because I put it on the chat. It's not the time to break the thermometer, and I completely concur with Charles-Antoine. This is not the moment for tweaks to measurements The measurement infrastructure is here. It's not perfect. It's what it is. It's not that bad. And confidence that the authorities are making the right assessments is more important than what this or that bank can gain or lose from this or that tweak. So basically, we should not change accounting standards. We should not change measurement standards. It was a very good decision by the EU not to change IFRS 9 in the course of the crisis, contrary to what the US Congress did, by the way, but that's a different discussion. So the EU did better than the US on that front in this crisis so far. But that's not going to make the ECB's work easier. I mean, at the end of the day, I've referred a lot to fragility and the assessment of whether the system is fragile or not. And by the way, like as Nicoletta has said, I think at this point, it's too early to declare fragility. There is no indication that banks won't be able to get across the desert, as Mr. Enria put it in a previous intervention. But if there comes a point where the ECB thinks, okay, now the system is fragile, and as you know, fragile is a euphemism here for non-viable, then resolute action will have to be taken very quickly. And resolute action, as I've pleaded, is not asset relief, it's public recapitalization. I'll stop on that note, and thanks very much again for having had me today.
Welcome. And so let me stop here. I'm sure that we could continue for still another hour at least, but we need to stop because we reached the hour. So let me thank Nicoletta again, and Nicolas, and also Charles-Antoine, who have unfortunately had to leave us, and all the participants that have stayed with us for the time. This was very interesting, and thank you very much.
Thanks a lot.
Thank you.
Thanks, everybody.
Thanks.